It is Sunday, February 23rd, 2020, about 3 hours until the futures open, and I believe the market is underestimating how bad price action could be next week. I expect some sort of salami crash that will be reminiscent of the price action in February 2018 or Q4 2018. And in this presentation, I will explain how I came to that conclusion. The last few years, we have had bipolar markets. We have two different volatility regimes. We have this grind higher with very little intraday volatility. This price action is persistent most of the time. It is now the natural state of the market. And then we have every once in a while this salami crash environment with heightened volatility and a lot of momentum, big gaps overnight, and then a move further in the direction of that gap. And both of those volatility regimes are a consequence of the hedging activity of market makers. And let me explain what this means. In the last few years, the volume in options trading has just exploded. And because options have leveraged, the hedging activity that is associated with that is now the single most important factor in determining price action. Economic reality is no longer represented by the S&P 500. And the reason for that is many, but here are just a few of them. One being that we've now had low interest rates for 10 years, and there's a lot of institutions out there that require passive income to meet their obligations. And if they cannot earn enough interest by owning government bonds, they are forced to create an artificial stream of dividends. So this need for yields forces them to sell options in massive quantities, and because there is no natural buyer for all those options that they want to sell, the market makers take the other side of that trade. But because there is just so much volume there, that risk associated with that position needs to be hedged. So please keep that in mind. That is one part that explains one volatility regime. Then we also have this Fed put in the market. We all know that Jay Powell has our back. So if anything bad were to happen, he would go back into the basement, print a bunch of dollars, and the market will most likely recover. This means a lot of institutions, a lot of hedge funds are aggressively long. And what do they do to protect themselves? They buy out of the money puts as crash protection. And also because there is just so much volume in these out-of-the-money puts that there is no natural seller for those puts, which then means that the market maker also takes the other side of that trade. What does all this mean? It means that the market maker is now long at-the-money calls and puts, and he is short out-of-the-money puts. And that all translates into two different hedging activities that market makers have to do. And to explain what that means, I'm borrowing this chart here from Charlie McElligott of Nomura. And here we see two different graphs that represent the gamma hedging that market makers need to do relative to the price of the S&P 500. And in this green rectangle, that is when market makers are long gamma. So that is when they are buying calls and buying puts that are close to where the current price is of the S&P 500. And to hedge those positions, market makers buy every dip and they sell every rip. This causes then the suppression of volatility, and it causes the market to slowly grind higher. But when price then drops below this threshold here, and they go from being long gamma to short gamma, their hedging activity flip-flops. Now the market maker has to sell into weakness and buy into strength. And that is when we get this heightened volatility, when we get these overnight gaps, and then we see more pressure in whatever direction that gap was. And I believe on Monday we will have a gap to the downside, and this will put market makers short gamma, and that means we will be in this red section here. And I believe this will start an avalanche of selling, because we have now a dangerous cocktail that is very different from the past. The last few years there has been this wall of worry and there was a lot of skepticism in the market, but that changed when Schwab went to zero commissions. It caused some sort of frenzy for the retail investor that went aggressively long those tech names. We also can see there's a lot of speculative call buying from small investors, where we can see that it is the little guy who's going long calls. It is not the institutions. So we are seeing that now, finally, after 10 years of this bull run, the retail investor is getting long and he is aggressive. And we could see on Friday, despite the terrible price action, that the retail guy was still going long speculative calls. This is a terrible timing to do that, because we also have headline risk, and that is the coronavirus, and we have Bernie and Super Tuesday coming up. And this makes things very, very dangerous, because there has been a lot of put buying to protect from a potential Bernie nomination and from what happens on a Super Tuesday. So that means there is a huge amount of out of the money puts out there that the market makers are short. So if we now see a gap to the downside, then selling pressure during the day, and then a cascading of that, the gamma position will get shorter and shorter for these market makers. And the further we go down, the more they have to sell into weakness. This can become very dangerous. And this chart explains that relationship pretty well. This is the VIX, a daily chart, and we can see how volatility changes relative to the positioning of market makers in the options market. When they are short gamma, we see this spike in volatility. When they are long gamma, we see this grind lower in volatility, the grind higher than in the S&P 500. And if we do see a gap down on Monday, which I believe we will see, this will put market makers short gamma, and we will likely see another spike here in the VIX. The magnitude of that spike is yet to be seen, but I believe because we have this dangerous cocktail, it will be significant. And that is why I'm very worried that people do underestimate how vicious this sell-off could potentially be. So what does all this mean for the S&P 500? Here we have a daily chart, and we can see when market makers are short gamma, we see these sell-offs that last for about a week, maybe two, and in size it is something between 5 and 10%. And because we have this dangerous cocktail, I expect it to be closer to 10%. So I'm looking for a target of something around 3,100, and that is if we only get one leg to the downside. I can make the case that we will have a couple of those and that there is more downside than 10%, but I don't want to be too gloomy. I just believe it makes a lot of sense to be defensive going into next week, and a gap down is just a confirmation of that. It is just the beginning. I do not believe the gap down on Monday will be the time to buy the dip. If you want more information, you can find it here on quantyetti.com/UVXY. If you have any questions for me, hit me up on StockTwits. My handle is @OptionBob.